All right, good morning, everyone. Thank you for joining today. I would like to welcome this group of senior executives who have joined us for the Executive Dialogue event. So I don't believe there's been such forum for most of the senior wealth management leaders in this country. So we're glad to be a part of it and glad to host this discussion for you today. My name is Jazz Olick. I am the Vice President of Key Accounts, and I will be participating to moderate and facilitate our dialogue. Our speaker, who needs no introduction, is Goshka Folda. In today's session, Goshka will share investor economics' unique perspective and provide a forum to exchange views on critical questions of the day. So, we are encouraging this group of executives to submit questions directly to Goshka to shape our dialogue. To submit your questions, please utilize the Q&A feature in the Zoom meeting at the bottom of your screen. We'll be sure to address as many as possible as we go through the queue. Now, for everyone on the line, if you do feel that your connection is dropping or something's interrupting with your Zoom call, try to dial back in using your phones or the direct line and see if you can get back on. You'll still be able to hear Goshka during this discussion. So we do encourage everyone to submit questions. But before we do that, and while we're collecting your questions, Goshka does have a few opening words to kick off our call. Over to you, Goshka.
Thank you very much, Jazz, and welcome everyone. Thank you so much for spending the next half an hour with us. Clearly, I know all of you, and you know how much I like to see everyone's face. This is clearly a very new medium for us, so I hope we're going to do an okay job and you're going to enjoy this session. And please let us know after the session what you thought about the format, and we will continue to iterate as all of us have to work from unusual places. I'm hosting you today in my house in Etobicoke in Toronto in my library. So thank you very much for joining us. I know this is also a very busy period just before the holidays. High holidays for Passover are already underway, so I particularly appreciate you dialing in today. So what can I say about the current circumstances? We're still we're all learning how to live with this. It is clearly for many of us, it has been almost a day-to-day, just an adjustment, just to make sure that BCP or business continuity planning, which is now probably the most powerful or popular acronym in the business world, just to get those things going. But also at Investor Economics, you know, as challenging as these times are, we are really uplifted by the fact that that you are reaching out to us and we're reaching out to you as much as we can and really sharing our ideas and thoughts. Because ultimately investor economics, and we'll see that on some of the slides that I'm going to show during these opening remarks, is our DNA is the data. It's about the data, it's about the context, it's about understanding what's going on in the world and trying to really discuss these ideas with you. So we are still waiting for a lot of data in Canada. Carlos's team, Guy's team, Brett, we're all gathering a lot of information. So in the next week to 2 weeks, you will see a slew of new information coming to you from us. But while we're waiting on that, I did want to share a couple of ideas from our US databases. So we've got, you probably all know, our SimFund analytical platform. In the US, we have the benefit of actually looking at some weekly flows for funds. And what have we been seeing? As you could imagine, the reaction has been swift to what's been going on. I guess the shock translated into a very fast rush towards the exits in the form of the safety zone of money market funds south of the border. So our weekly fund flows suggest that in the 4 weeks ending April 1, which is the latest data point that we have in the US, you will laugh at this number, $666 billion went into, in terms of net flows, into US money market funds. So that's an enormous amount of new money. And actually, if you think about the asset base of the US money market funds, that's about 21% of the asset base. So this kind of a rush towards liquidity is something that was extremely powerful. We like, that we have history. We've gone through quite a few bear markets. I feel that I've got the battle scars to to document that. But when we look, for example, at the 2008, the kind of the big rush towards liquidity in the U.S. In October 2008, we're in about $100 billion in the month of October, and here you have 4 weeks of 666 billion. You can see this is quite extraordinary, and I think what we're hearing about the Canadian market, and Carlos's team is also gathering tremendous information about deposit business, high interest savings, short-term GACs. We are again hearing that this fear, investor fear, and maybe even advisor a kind of concern for the client holdings is pushing a lot of clients, a lot of investors into the safety zone of those very short-term positions. So in Canada, we'll be reporting more on this data. You'll see we have a couple of stories already queued up on the liquid savings. We will continue to explore whether those patterns hold. What's going on in terms of the long-term funds? On the next slide, what you can see is there was clearly a very rapid drawdown in terms of both predominantly mutual funds. We don't have the full data set in the US on the weekly. We're waiting for the end of March data set, which will be then completed, and we'll definitely share it. And same for Canada. By next week, Carlos and team will probably have a lot of data thanks to the IFIC data feed. But what you saw a couple of weeks of profound drawdowns, but still in the big scheme of things, they were for the long-term mutual funds about 2.3% of beginning assets. So vast, nearing $200 billion, but not really extraordinary. And we think that the asset allocation programs that are also very popular south of the borders are accounting for the fact that actually there's powerful drawdown and redemption activity, but we're also seeing some sales, especially when you look at the core categories such as US equity. ETFs on average have fared a lot better, but let's see what happens as the time goes on. So I think I just wanted to give you almost a little bit of a perspective of early returns. And of course, it's the Canadian data. One of our funny taglines is that we are data junkies. So we are just basically, just ready to pounce on the data set once it arrives from IFIC, and really trying to figure out what we can report back. And we will continue to talk to all of you individually and collectively to gather more data and provide you more context. Because as everything, and this is what battle scars are for, they're to tell you that no bear market, no financial crisis, no medical crisis are alike. We are living in a very unique situation, but yet I take great solace that every time that we think that there is no tomorrow, tomorrow arrives. So with that, I'm going to pass it back to Jas to ask some of your questions.
Thank you, Goshka. So we do have a few questions coming in already. So thank you for those that are submitting. Please continue to submit your questions as you think of them, and we're going to direct them right to Goshka live in this format. So let's kick things off, Goshka. So we're in a fairly transformative event with social distancing in this pandemic, operating virtually. Once the pandemic subsides, what are your thoughts in terms of how the retail wealth industry will evolve as a result?
That is really a great question. It's a very big question. We probably could spend the better part of it, not just a half an hour, but an hour talking about it. But one thing that I think is really powerful, you might recall seeing me many times talk about the four exogenous or external forces that are acting on the wealth management, asset management business, banking business, and so on, advice giving. And those would have been the demographics. Nothing has changed there. It's kind of an unmovable object. Regulation, some changes, and I think we're going to see more changes after this is all said and done. But technology was another big disruptor. And what we found was that technology was disrupting a lot of businesses. But I think that we saw a lot of resistance. The system once, with the high tide lifting a lot of boats, it's what Mr. Buffett said, that it's when the tide comes out, we'll see who has been swimming naked, which I really love. It's the fact that probably not everyone has prepared for this new world that is now clearly driven by the ability to adapt with technology that can connect you to your clients, to your advisors, to your distributors, to your channels, your own channels, to your colleagues to resolve the problems of the day. So what I think coming out of that, we're going to think, I don't think that we're going to see a fundamental shift in the way that products and services are delivered in terms of the solutioning and the content and the objectives that they are supposed to solve for investors. But I think you're going to see a lot greater pace of adoption of technology. And because we are really living, an example that it can be done. I was talking to one of the leaders of an asset management firm a few days ago, and we were, the individual was sharing with me how their wholesaling efforts are changing with the fact that their wholesalers don't have the ability to travel. South of the border in the US, we ran a very interesting advisor pulse survey, and it talked all about how advisors want to hear from wholesalers in a kind of with a technology connectivity, more so than a telephone. They would like to have a video chat, but it has to be with great content and expertise. So I think that at the end of the day, I think companies that have kind of nailed the idea of technology being a powerful amplifier of the value proposition at every stage, and figuring out that end-to-end client experience that's technologically modern, I think are going to benefit. But I think that also it's going to expose that some technologies without the scale to really invest in them are not really possible to execute. One intriguing idea, and we heard Mr. Fink of BlackRock fame speak in his letter to shareholders last week about the fact that technology is also going to more powerfully change the asset management, the portfolio management science. And I think that as we look at the events of the past few weeks, we recognize that without the support of technology, artificial intelligence, ability to go wade through reams and reams of real-time data, it's going to be very, very difficult to run a very modern asset management organization. So though that would suggest that those firms with scale will be able to do that, and those who don't have scale will struggle a little bit. So I think technology is going to be a much more powerful enabler and amplifier of value propositions as we go forward, because we're almost living the proof positive and acceleration as a result of the medical crisis. Jazz?
Thanks, Goshka. So we've just received a number of questions, so we'll go to the next one. Given the steep and deep drop in economic activity, do we anticipate households will need to raid their savings? How will the industry cope with that over the medium term?
What a great question. Big unknown for sure in terms of the macroeconomic scenarios. Over the past 3 weeks, almost every economist has come out with, we think it's going to be that, and next week they're coming up with the opposite perspective. So let's see what happens. But clearly, as a minimum, the short-term pain is going to be profound for many, many households. Again, we've seen another million Canadians file for unemployment insurance, or the job losses amounted to about 1 million. This is really, really profound. It's going to really impact the purchasing power, but also the saving ability of Canadian households. So we're hopeful that the government is going to continue to reflect on that and try to support households in that. But I think in the short term, we are expecting for the immediate savings, and I think part of that liquidity cushion that households have been likely building in the past few weeks, is a reflection of the fact that they are really, if you will, hunkering down for the longer haul. But what it means to the longer term savings, I think it's going to be a critical discussion. You might recall that last year in the House of Balance Sheet report, we wrote about the fact that it was pretty bad in 2008 and 9 because of the demographics of the Canadian population, which had anywhere between 5 to 10 years to retirement. Now we're 12 years later, we have many households who are living through this crisis as they're approaching retirement or imminently moving into retirement, already in retirement. You can just imagine what kind of anxiety this is creating. So not only depletion of savings, but just anxiety about the financial security in the retirement. I think this is something that is going to be, I will issue this call to action for all wealth managers, asset managers, advisors, Canadian households, and the digitally driven advisors. Canadian households will need a lot of support and a lot of help. So I think that I think in the short term, the impact is going to be profound. Of course, then there is also the mountain of debt that's sitting on the Canadian household balance sheet. It was profound in 2008. But it is almost not quite double, but 80, 90% higher 12 years hence. So these types of difficult ideas and difficult decisions that households will have to make is going to I think, really, if you will, provide an opportunity for the industry to guide and assist, but it's going to be an arduous road. So certainly a lot of anxiety out there, and all of us probably are hearing anecdotes from our neighbors who are shouting across the street or calling us, or it's definitely a very anxious time for households, and we will continue to monitor just how much of in the short term of savings is going to be consumed by just meeting living expenses.
Thank you very much, Goshka. Thinking about asset management, have you seen evidence of passive management underperforming active management? Is this crisis good for active managers?
Well, I will rephrase the question. I will answer the question. So we have not seen that evidence as yet. We're looking, Canada is very early on. We're looking at Europe. We are looking in the US. It's very early on in terms of the investment performance. I think the general thought would be active management has been under some duress and scrutiny, and the passive index tracking management has been really kind of winning a lot of flows. I was just looking, Carlos just gave me some interesting data through February in Canada. $26 billion in net new flows into long-term funds, of which about 45% went into ETFs, broadly understood to be the index, even though not all of them are index tracking. Last year, that share was more in the 60-70% range. So clearly a lot of money has come into the passive. And unlike in 2008 and 9, where a lot of the new passive products, we saw the explosion in the ETF availability, really, I think, it was easy to be an index fund to really deliver some eye-popping returns. And the story from the active managers has been, well, wait for the downturn. We're going to prove our mettle. Again, it is too early to say that. The common wisdom would be that active managers should be able to perform better, have a smaller downside capture rate. But will it really happen? I think that we need to wait for the data. But I will just say this: if active managers are unable to deliver on that premise through this down cycle, and again, we have to wait for the recovery, because also the capture of the recovery is going to be interesting on the active side. I think this is almost the next stage of the battle between active and passive. I think passive are, I'll tell you something, how passives are somewhat exposed, because I call it, and again, this is my almost 30 years in the industry. I get the benefit of seeing this come and go, but I call it the curse of being the core holding, the curse of the core. So in 2008, post 2008 and 9, passive instruments, ETFs, were not a core holding in advised portfolios or in investor portfolios. Now, 12 years later, many portfolios are anchored in broadly diversified index tracking ETFs with active management surrounding and being the satellite. So if any underperformance or any powerful losses, I think, are going to be very exposed very quickly. So that means that index fund providers, ETF providers, have to really manage their clients' expectations around that. But for active managers, this is the time to deliver. This is the time to tell the story and explain how active management can really counterbalance that kind of an index tracking strategy. But no evidence of that as yet.
Thanks so much, Goshka. Just kind of adding to that point, do you have any predictions on how the segregated fund market may perform in the near term as a counter-cyclical product?
Wow, great questions. I love these questions because they're also hitting some of my personal pet peeves. Again, a lot of you know me for a long time. I've been one of those, I find maybe a little bit wolf in the desert howling at the moon about the importance of some guaranteed and insurance products. And certainly when it comes to segregated funds, we saw them kind of miss out a little bit on the opportunity provided by the 2000-2003 bear market because mandatory reserve requirements came into being, and there was a lot of anxiety about that. Then post 2008, we had, of course, 2006 and onwards, a great success of the guaranteed minimum withdrawal benefit products. But then those were damaging to the life insurance companies' balance sheet management. So they were kind of set aside. I think, again, any bear market from where I'm standing provides, I know it's kind of too late to start insuring once the market is down, but provides actually, this is when investors and advisors are probably most interested in listening to risk management stories, and any type of instrument that really provides the opportunity to protect against some black swan events is I think a powerful marketing and sales story. But that story needs to be out there, and it needs to be delivered, and the product needs to be available. So I think we're going to see actually in the next couple of years the market demand more downside risk protection products. I think the timing is very, very good. Same could be said of certain types of alternatives that are uncorrelated to the market returns. We saw some eye-popping returns from some US hedge funds, and others not so much. But anyway, I think that this is going to be a very good time. But I, again, issue a call to insurance companies to put together those stories, engage advisors and engage investors and clients ultimately, because this is a story that maybe has not been powerfully delivered at every stage of the past bear markets that we've gone through. Thank you for this question. I love this question. Thank you, Jazz.
Thanks, Goshka. We keep getting more questions, so this is great. Thank you for everyone that's submitting the questions live and facilitating. So shifting gears just a little bit, what are your thoughts on consolidation through mergers and acquisitions post-pandemic?
Well, I like to talk about consolidation was something that we were envisioning before this market disruption. Those of you who read the 2019 House of Balance Sheet report know our thoughts about that. In the US for some time, of course, this is where there's a plethora of asset managers. We've seen some big consolidation happen. Franklin Templeton just acquired, was in the process of acquiring like Mason as this crisis hits. So Invesco Oppenheimer is another example. So definitely, I think we're going to see an acceleration of that. I think that what I like to think about is that point that I made about technology, about scale. Scale is very important when the asset base valuation is not there to cover up some deficiencies in terms of the optimized business models. So as a matter of fact, we were thinking already that wherever functions at asset managers or wealth managers are suboptimal, more and more companies will either have to consolidate with others or merge with others, or they will have to actually ship some functionalities outside. So I think that we're going to see an acceleration of that. I am worried that actually this time around, the acceleration, typically what we see during the deep bear market is a pause in all mergers and acquisition activity, because companies or the owners of the smaller units that could be acquired or want to be acquired are waiting for the valuations to pick up again. I don't know if this is going to be the option during this market, because I think that duress is going to be probably pushing some companies to just basically figure out that they need to leave. But the caution for me about scale, it's not just about scale. I think it's a scale with what I call strategic intent. So not just scales, but scale with strategic intent. If you want to be an acquirer, you have to have a clear vision of how acquiring or merging with another partner is going to really make you better in terms of your ability to put together products, manufacture them, lower the cost of manufacturing, maybe expand your business in a different way, and secure you technology that is going to really advance your cause with the end clients and advisors and your distributors. So I think that we will see an acceleration, but I think it's going to probably take a little bit of time. And I think that the more strategic it is, I think the more successful these mergers are going to be. Thank you, Jazz. Great question.
Thanks, Goshka. So we do have 4 minutes left, but still a number of questions coming in. So what we're going to do is just a quick announcement that for those that, for respect for your time and your schedule, if you do need to drop at 11:30, please feel free, because we will send a recording after the call. But if you are able to stay longer, we are going to keep Goshka for 10 more minutes. We're going to do our best and answer a few more questions and continue. So Goshka, we'll move to the next question now.
Okay.
So far, you've talked about the wealth management industry adjusting. Do you think instead this pandemic will lead to a fundamental change to what we view as wealth? So for example, beyond money.
Wow, this is a big philosophical question almost, and I'm delighted that somebody thinks that I have an answer. I think we are already seeing it from the millennial generation, even before this pandemic. I think the perception, the traditional perception of wealth, be it real estate wealth or financial wealth, investable wealth, was certainly, I think, maybe not quite as permeating the millennial generation, and certainly the Gen Z generation. Really kind of powerfully. So I think that we will continue to see that perception of wealth is evolving just by nature of the younger generations having a different idea. That said, I think that it's going to still take a long time for the demographic cohorts to move through that decumulation phase, and those big cohorts that are right now either entering already in retirement or about to enter retirement are the baby boomer, which is a very large cohort, and then the Gen X generation, which is going to take us all the way kind of in terms of dominance of the financial wealth, for the next 20, 30 years. So it's a very, very long term. But I think that one aspect of wealth, even investable wealth, that is going to, again, probably come out more articulated or better appreciated from this down cycle is that idea. I talked about the product guarantees or guarantee of capital or guarantee of income, but also I think there is going to be a thought given to the alternatives. And again, alternatives is this very, very large area with very diverse types of portfolios in there. But I think that we're going to see more product development and more strategies aimed to really, try to preserve the wealth. Beyond that, I think that we will all probably, I know that is definitely the case for me, understand that the true wealth is the network of clients and the ecosystem of clients and friends and family that we have because this is really truly who puts us, who helps us move through these most challenging times. So I think that that's my overall reflection on wealth, if that's worth anything.
Thanks, Goshka. Appreciate that answer. So we got two big questions coming up. So we'll see if we can get through both of them.
Sure.
One on regulation. So
Okay.
while there may be more regulatory changes after we get through this, do you expect regulators to pull back on some of the already announced initiatives? For example, ban on DSC, ban on trailers paying through online discount brokerage channels, for example?
Mm-hmm. This is an excellent question. So coming out of the 2008 and 9 crisis, of course, we saw almost an absolute change in attitude by regulators, moving from a kind of a reactive mode, because I think that a lot of critique was launched at them for not anticipating the challenges of the financial crisis. So I think they moved into a very powerful proactive mode and launched a number of initiatives. I think that I will continue to think that post this disruption, probably regulators will do a bit of a soul search as to what are really truly the most important ideas. I think there is an important opportunity for advice givers, for advisors on the front lines, to actually demonstrate that this is a time when the value of advice can be best appreciated by both investors, clients, but also by the regulators. So I think that we will see probably an evolution of the regulatory docket. It's very early to say. We haven't seen any major, kind of disruptions in the wealth management business to really try to see if they feel that they need to course correct powerfully. But I think given the fact that everybody is busy with business continuity planning, and the regulators, securities regulators have to also think, just like the banking regulators, they have to think about fraud and about all these things that are coming out of the woodwork as a result of the pandemic. So I think that we're going to see probably, if anything, I would think there would be some postponement of some of the files. But I think it's important to understand that it's very, very difficult. My experience, and again, I'm not an ultimate world expert on regulation, but it's difficult to squeeze that genie back into the bottle. Once the idea that the fee-based planning, is really de-emphasizing the importance of the deferred sales charge business. So even in the absence of a regulatory demand to discontinue that type of load structure, I think the market is going to move more powerfully. Everything that I've seen over the past 28 years tells me that in the post-crisis, it's not back to square one. It's an evolution, and the change typically accelerates rather than decelerates.
Thank you, Goshka. So we have about 7 minutes. This one might be the last question. So going back to households, where will Canadian household indebtedness go from here? On one hand, we have rock bottom rates. On the other, we face great economic uncertainty and tough employment numbers. Do you expect a credit contraction?
Carlos's team puts together some very, very interesting data. And even during the 2018, remember there was that short-term disruption related to the cannabis stocks and market weakness globally. In the fourth quarter of 2018, we already saw the deceleration in the rate of increase of credit taking by Canadian households. So not an outright decrease in the credit pool, but a deceleration in the increase. Of course, the last few months, again, real estate valuations started popping up again, these in major urban centers, and that again prompted for some of the credit taking to accelerate, again, low rates. I think that now is probably going to be a really powerful wake-up call to many, many Canadian households that really trying to survive with job security not really there, and carrying this significant load in the form, or significant kind of a big sack of credit on top of that. I think we're going to probably I don't think that we're going to become like depression babies who came up in the age of the 1929 and 30 crisis and just abhorred any debt of any kind. But I think that we're going to see a very significant pause in credit taking, and I think that that's a given amidst economic downturn. But I think that also that anxiety that households are feeling about their financial security overall and retirement security, I think is severely compounded by the fact that they are continuing to carry significant debt loads into retirement. So we've seen already, kind of a great statistics about the 55 through 64 cohort. 3/4 of those households have saved less than $100,000 as they move towards the retirement. And many of those households are carrying debt. So these you cannot get those two things reconciled easily. So I think that we're going to see probably a deleveraging impact of this, just like we saw even that little disruption at the end of 2018. I think it's going to be a lot more powerful. And the debt management is going to become one of the top priorities, I think, where it's already becoming that. So that would be my answer to that question, Jazz.
Thanks, Goshka. So I think I'd like to move now to your closing remarks, and I know you have a slide to share. So I'll pull that up and we'll switch to that very quickly.
So I will take just a minute. I know we're over time. Thank you so much for staying with us for the duration. We will be sending an email. Jazz will tell you all about that, and you don't need to write any of this down. These are really the key takeaways from 2019 Household Balance Sheet Report. And you will say, well, why are you sharing those? We're a year later and a cosmos away from that situation. But as Nicholas Taylor of the Black Swan fame said, great ideas have the benefit of being very sturdy regardless of conditions. So the Household Balance Sheet framework has really helped us think about Canadian wealth and the wealth management business at large in powerful ways over the course of past 28 years. So when I reviewed the key takeaways that we prepared actually for you, the executives and in the business, actually about a month ago, I found that a lot of those ideas still hold very much water after the events of the past few weeks. So we will continue to monitor those things. And my closing sentence to you will come from The Tale of Two Cities, Mr. Dickens's words written 161 years ago. It was the best of times, it was the worst of times, it was the age of wisdom and the age of foolishness. So we hope that collectively we will land on the part of the wisdom. And you know that I tend to be more of a glass half full type of person. So I think that with every great disruption, there's great opportunity to rethink your business, to really move it in a solidify the direction and move into a new direction that will permit you to really be successful in the long term and conquer new competitive territory. So that's it for me. Thank you very much, and I'll just pass it back to Jazz for the closing words. Thank you very much.
Thank you, Goshka, and we also thank everyone that joined today and submitted such incredible questions to Goshka. It really helped drive the discussion, and it was very, very interesting to moderate. A couple of things to close off. So we did miss a few questions that we'll probably answer directly. So we do know who you are, and Goshka will reach out and answer some of the questions we did not cover. Second, there will be a follow-up email sent to you with some of the key takeaways that Goshka did mention from the household balance sheet, and also a recording of the session. So in case you wanted to recap some of the thoughts that were presented. There'll also be information on how to keep in touch with Goshka if you want to schedule a one-on-one or a follow-up call to review this in person, in more personal venue. With that, we'll be signing off from this event, and we look forward to seeing you all again virtually and hopefully in person very soon. Thank you, everyone.
Thank you, everyone.